of types of investment by seeing a sort of comprehensive landscape. I don't know if we can see it. It's really important that we see at the bottom, there's a piece that says decreasing risk. And that's important because what investors are looking for is lower risk that ties to the amount of money that they will put in. So, for example, when a business is a startup and maybe it has a few first customers, that demonstrates that there's a little bit of risk that's been taken off the table. Somebody wants to buy what they're selling. So you might be able to raise 100, maybe 250,000 at that point. As you move down the line, let's say you now have proven unit economics, which means you know exactly how much it costs to produce, in Rena's case, a new exhibit and get, let's say, 25,000 people in to pay for tickets to see that new exhibit. You know the costs of the units and how much everything will cost as you scale. And because of that predictability, you have less risk in your business. And so an investor is willing to put more money in. So you can see, for example, that someone who has growing profitability because they've figured out their unit economics, they're growing, into new countries, they can raise up to $100 million or more because there's very little risk at that point. They're kind of a proven thing now. So the amount of money you can raise is tied to the amount of risk that an investor perceives in your business. So if we go to the next slide, you can see that because early investors are taking a ton of risk, like it's really risky for them to come into a business and say, oh, you don't have customers yet, but you have this cool widget. Well, I guess I'll put in $50,000. They're taking an enormous amount of risk. And so their mindset around returns is they want to see something maybe like 30x their money. So that's for angel investors really early on. The likelihood that they'll get that money back is very low because if they made 20 investments, maybe one of those is actually going to hit 30x, if any at all. So that's why to get any money back, they have to look for bets where the potential for ROI is huge. If you're talking about, for example, a business that maybe has proven unit economics and is looking to raise $7 million and, let's say it's a hamburger stand that's now going into 10 more states, right? So they're going to raise $25 million. Those investors are coming in after a lot of the early risk has been taken off the table. And as such, their return potential is much lower, right? So they can maybe make 3x back, but the likelihood that they'll make that 3x is much higher in any given investment they make than the early angel guys. So the layer that goes on top of the last slide is this layer, which is what kind of investors are expecting what kind of returns. And it's tied to where a business is at in its growth phases.